Welcome to the first On the Call presentation of 2018. Now, for those new to our quarterly calls, this is a service of Zacks Institutional Services and is a live conference call featuring Zacks Strategist providing their analysis of the latest issues and trends, not only affecting investors, but also the markets, including but not limited to current issues, current trends affecting the market, the economy, both globally and here in the United States. Our Chief Equity Strategist, John Blank, and Research Director, Sheraz Mian, are going to be our panelists today. John's going to tell us what he sees as the 10 biggest market risks for 2018, and then Sheraz is going to take a look ahead to important earnings trends for the year. So, John, as always, we're going to start with you. Markets started out the year strong. Still, you see some main market risks that concern you as we begin this year. What are they?
Yeah, Terry, thanks. First of all, I am bullish, everybody. I am putting an S&P 500 target of 3,000 for the end of the year, which is a 15 to 20% climb from this year. So I am bullish. Keep my risks in the context of the bullish strategist generally. But I think this 2018 is going to play out in a way that nobody can imagine, because there's just way too low of an assessment of risk that's going on right now. We all know that market goes up every day. Volatility is historically multi-year lows, and that's all insane in my mind. However, I don't have a crystal ball and thinking about when and what could happen, other than to give you my 10 rank order risks. Now, the point of what I'm going to do today is rank ordering. I'm a mathematician, so rank and order are what I'm after here. My 10 risks are going to be showing you what I consider in time and in influence, what I consider the most important. So when I force myself to think about these 10 risks, the first ones are the ones I'm most worried about in time. They're most likely to happen early in the year, and they're most likely to be more impactful on the stock market. Everything about everything I say today, it's all about the stock market. I'm not making any calls on the economy or our political system or the global economy. Nothing of any of that. My focus is basically on the S&P 500 and all the other indexes that track it, including the small caps and the mid caps, in the U.S. context. So keep that in mind. And the number one risks in this scenario is the NAFTA, North American Free Trade Agreement, between Canada and the United States, which has been in place since the 90s. Lighthizer and Peter Navarro, who we haven't heard much of, and Wilbur Ross are negotiating this deal. They're in their sixth round, and that sixth round will happen in February. So this thing is going to be here very shortly, and this president has already pulled out of the Trans-Pacific Partnership in Asia. So it is not hard to imagine this does not go well and we leave the NAFTA in February. So what happens when you leave the NAFTA is you sign off on a 6-month agreement to leave the NAFTA. So leaving the NAFTA won't actually happen effectively till 2019. So why does it make the case that the NAFTA is in my first list? Because the market is pricing this tax thing, it's pricing pro-growth, and everything I know about this market is synchronized global growth, and that the real drivers of the stock market right now is the global growth. And if you hammer NAFTA, the unintended consequences will go all over the place in a contagion type event. I have no idea how that's going to happen, but forward-looking markets can price it in very quickly. Now, Oxford Economics just yesterday came out and said if NAFTA blows up, 0.5% of GDP will be knocked off the U.S. growth rate. So that is effectively more than the tax gain in terms of growth. So we can lose all the growth in the U.S. economy that came from the tax cuts if NAFTA blows up, but it won't happen until 2019, not 2018. So it's all, in 2018, the risks of blowing up NAFTA are all in the contagion, financial concern, forward-looking context, so it's mostly a correction that I'm worried about in 2018. I'm worried much more seriously about growth in 2019. So let's go to my next slide. All right, so equity correction, let's go one back to my 2, 3, and 4. I see these three as the next core relationship of problems with the U.S. situation. Number 2, in order, these are kind of all together, they can all move together, but certainly the most important is the equity market itself is very overvalued right now. We're at 18.5 times forward earnings. The average is 14 to 15. This is we're easily able to see, and we're probably overdue for nothing more than a garden variety correction of 15%, and that can easily go to 25 or 30%, no problem, just on valuation. So you have to remember, all the good news Sheraz is going to bring up into the game here at the end of this call has already been baked into this market, and then some. So any good news is not going to do anything for this market. Any bad news will kill it, and the only way you're going to get us to a higher level is to actually deliver some positive surprises to an already rosy picture. It's very unlikely. So the third is the high yield bond markets. And the fourth, obviously, is a potential Bitcoin collapse. I wrote this a month ago, and as you already know, Bitcoin is collapsing. Now, here's the scenario of how I think Bitcoin plays out, because it's not clear to me that people understand this. Bitcoin volumes are picked up in 3 countries, 80%: Vietnam, Vietnam, Japan, and South Korea. And all the mines where all the inventory of Bitcoins is in China. So the entire Bitcoin event is an Asian event. Now, in the last year, the top stock markets in the world were not the United States. We were at 23% returns. China went up 53%. India went up 37%. South Korea went up 40%. So the huge rip of momentum in Asian stock markets is got to be full of leverage. And the same people who are chasing those stocks up are chasing Bitcoin up. And as you know, Bitcoin, the regulators are clamping down on this. Now, when I was the chief economist of the Merck, the most high volume futures contract in the world, and this includes the S&P 500 futures and includes the Eurodollar futures, the most high volume by a long margin was the KOSPI, the Korean Stock Exchange futures, because they were little tiny contracts, and the gambling over there was unbelievable. So you have to remember that this is the typical thing that happens in Southeast Asia when momentum gets on anything. If it moves, they buy it. Now, what's going to happen here is it's already getting shut down in South Korea. It will get shut down in these other countries in a Me Too effect, and that can spiral into the stock markets in Asia. And that's the concern here, is how you get a Bitcoin collapse is through a collapse in leverage in Asian stock markets as feeds into the U.S. So again, my concern about Bitcoin is outside the U.S. Now let's go to my next slide so I can talk about the high yield markets. The other thing to know is that risk on and risk off is best understood through the bond market. This is a double B yield, but I could have a triple B yield. Anything, a B yield, I mean, I got a C yield. All these things move together. So as you can see, when the oil price collapse came and went, it all started this rally back in early 2016. And you can also see the 10-year B of A double B rate is 4.37%, which is as low as it's been going back years. So I'm telling you for sure that if you have clients that have high yield bonds, it's time to sell them, not buy them. That this is the bottom for the spreads in high yield. And now how these things blow up, again, I have no idea. You can see that they blew up in 2013. They blew up hugely in 2016 out of the oil thing, which was very different than the debt crisis in 2013. And the next big thing, who knows? But you can see here, this is the idea. It will come out of nowhere. We've been down here pretty long. All of 2017 is really quiet. All we need to do is get high yield to blow up to 5.6, 5.9, which is easy to do, and the stock market will take 15% off, no problem. So this is the other thing to watch out. There's all this love affair with this market because there's no risk baked into it, and the risk can show up out of nowhere, people. That's what I want to make my point. So let's go to the next slide. All right, the next level. Now, remember, I have NAFTA number 1 on its own. Number 2, 3, and 4 are overvalued equities, Bitcoin collapse, and high yield market, all wound together in too little pricing of risk. Below that is the ECB and the Fed. And in that order, I put the ECB number 5 and the Fed number 6, meaning you really got to focus on the ECB. And we saw that earlier this year when the Japanese Bank of Japan took some of the quantitative easing off and interest rates rose on the long end 15 or 20 basis points. So the point is, as the ECB, European Central Bank, starts to unwind stimulus, and that's going to happen in the middle of the year, they're going to stick it to the middle of the year. But after the middle of the year, the ECB is in play, and every monthly report from them is being very closely watched. And that is the period where the over-stimulus of the Trump tax cuts is going to run into higher rates. So the first half of the year, we're not going to see any payback in terms of rates. The second half of the year, we are. And you got to keep your eyes on the ECB. So the only reason the ECB and the Fed are this low is that I think it's really a second half of the year problem. But I think when the ECB gets off this game and they poorly execute this whole thing, this can take us a long ways, and a long ways can mean the stock market can hammer down pretty fast. So let's go to my next slide. Okay, so this is an example from the Fed perspective. They're gonna manage the U.S. economy under a statutory mandate around an expected 2% inflation rate. As you can see, we are basically there, and you can see that from 2014 through 2016 because of the oil price collapse. And I think what happened was China was underreporting its slowdown in growth, which is now going to underreport its speed up in growth too. But you can see now we're back on an uptrend, and we're back to that 2% CPI level that's at the Rubicon of where the Fed's happy. So the Fed's where it needs to be, and if it gets up above this, if we get into that situation where we get into the 3s, 2.5 even, the Fed is going to move to 4 and 5 and 6 rate hikes this year. And if that happens, all bets are off on what the stocks market does, because once the bond market starts looking more attractive, the defensive money will leave the stock market, start chasing bonds, and this has all kinds of ramifications. And the thing that I see most often when I read about things out in the news is that when this rate hike catches up to the Trump tax cut, it's going to be in the 4th quarter of this year. So people who do the math on these rate hikes are telling us that the thing is over and the top is in the 4th quarter, and that's where you got to keep your consensus on. That's what people think who are looking at this closely. Well, let's go to my next slide. All right, Mueller, midterms, and tax reform, 7, 8, and 9. We're getting down to the bottom. Now, I don't need to tell any of you guys that the FBI is investigating the president. There's four indictments, 2 guilty pleas on the table. Steve Bannon is being subpoenaed. I can tell you this, having been a foreman of a jury back in August, subpoenaing someone to testify at a grand jury like Steve Bannon means they are evaluating obstruction of justice charges to be put on the president right now. So that's what you should understand. Now, again, I put this very low in my list because the president does or does not get indicted for obstruction of justice is not a 2018 event. He will fight it, and it will certainly be a 2019 event. However, how it becomes a 2018 event is interesting. It happens because by all means, the midterm elections will go south for the Republican Party. They're already looking poor to begin with. So if he loses the House and maybe the Senate in this whole thing, because the Mueller investigations issue an indictment, which takes his approval rating even lower, then you have a scenario where there can be a thought in the market that tax reform can be reversed by the Democrats or at least slowed down. And that's how this thing works, is the unintended consequences of tax reform are most likely a 19 or 20 issue, but that can be sped up and moved forward by Mueller and midterm. And that's what you got to watch out here. But again, very late strategy here. I don't think this happens until at least October is when I think this stuff bites. So it's pretty low on my risk radar. Let's go to my last one. Oh, this is a great slide. Before we go there, this is a great slide, and I forgot about it, but let's talk about it. This is the gap between potential and actual GDP. And the gray lines are the recessions going back to 1980. You can see the big recession that was in 2008. You can see the smaller recession of the tech bubble, and you can see the early 91 recession. So what you notice is when actual GDP exceeds potential GDP, which you can estimate what the economy should be at. Once that happens, you can see it usually causes a recession 2 or so years later. It can be anywhere from 3 to 4 years, as you saw in the 90s. It stayed off for 3 to 4 years. In the 2005, 6, 7 year, it lasted, was very weak, and then it turned down. And you can look back into the 90 period, and it just got over that bill, but we didn't see a recession for a couple of years. So the bottom line is, when you hear about tax cuts, and you hear about all the logs being thrown at burning fire, and what they're driving at is that actual GDP, the GDP growth we're seeing, is reaching the point where the economy can overheat. Now, the reason to stay bullish is, as you can see, there's not one instance where a recession shows up as soon as you hit actual potential. So the bottom line with this chart is it's somewhat bullish for 2018, and it's very, very bearish for 2019 and 2020. This is the scenario. And this particular chart, study it closely, because this is for you as advisors. You're going to have to make a call in a year or two to get people out of stocks based on the approach of a recession. And this is the idea, that you've got to start paying attention to this. From now on, it's in the game. The potential for excesses come before recessions, and it's totally here, and it is now, and just keep that in mind. So let's go to my last thing before I hand it off to Sheraz. North Korea. All right, I put North Korea at 10 a month ago when people were still talking about it. I know North Korea is going to be in the South Korean Winter Olympic Games, and they're talking. First thing to keep in mind is South Korea had an impeachment of its president, and the new regime in South Korea is very positive on talks with North Korea. This is more important than anything Trump does or the generals do. So the bottom line is the Olympics and the new regime in South Korea is moving in this direction. That's what's going on. However, who knows with this guy, if he's using that as cover for actually moving some missiles out, whether he's taking a different approach and kind of playing a Trojan horse on this whole thing, who knows? So I leave it at 10. I don't think it's very likely, but the bottom line with this is kind of like a Bitcoin collapse. The problem with North Korea is not North Korea, it's that it blows up Asian growth, and if that happens, all bets are off on stock markets the world wide over. So again, I start with number 1, I end at number 10. They're both actually related to global growth. You have to be concerned that global growth is not synchronized. If something happens to it, the U.S. will not be immune. It will be affected. Now, that's what I have. Keep in mind it's a rank order, and keep in mind that the point of that is to keep you aware that you're going to hear tons of news about all this stuff all year, but keep in mind the idea of how important it is, right? How important is this news to the stock market? That's what I hope to add in my talk today. I hope that I communicated that. And the rest of this is going to be Sheraz taking you through what we're learning about the fourth quarter earnings and all the rest. Now, Sheraz, I'll let you take over, and I think I left you in a decent place to do that.
Sure. Thanks, John.
Hey, John, before we move over to Sheraz, I just wanted to get something from you here. What do you make of this talk that I'm hearing out there on the street about the possible near-term melt-up in the stock market?
Well, Terry, certainly it already has happened. There's no question that the market's pricing in the ongoing CFO assessments of the returns to corporate profits from the tax cut. There was some uncertainty when the tax cut passed between what the CFOs of major companies were going to do with it. And as that uncertainty resolves itself, earnings estimates are going up, and that is continuing to give support to the stock market. So the amazing thing about the Trump stimulus is it's very unlikely to stimulate growth, even though he's going to talk about it, which is very good because we can get a stock market booming without growth, and that's what we're seeing. And that is a way to not overheat the economy, but get a stronger stock market and justify the higher returns to the price earnings. So, Terry, it's really about the tax thing. and it justifies the multiple, and that's the good news, and it is good news.
Okay. Sheraz, let's bring you in here. Earnings season so far off to a pretty strong start, but even though investors are optimistic about Q4 earnings, with stock prices at historic highs pretty much across the board right now, are investors going to be demanding unusually strong beats and guidance to keep those prices up there?
Thanks, Terry. And yes, that's an excellent point. Thanks, John. You thankfully told us at the top of your presentation that you were bullish for the market. If we hadn't known that, we would have left that with the feeling as if doom and gloom was on the way. My presentation of the earnings picture for Q4 and 2018 as a whole should leave you with a far more reassuring and positive picture of underlying fundamentals for stocks. And as we all know, North Korea and political wranglings have a bearing on the market, but at the end of the day, the long-term most important variables for stocks are earnings and interest rates. Our focus today is on earnings. This first slide looks at the scorecard for the Q4 earnings season. It's very early, as you could see. The second column in this table shows you the percentage of market cap for the companies in the S&P 500 that have reported results already. And this is up to date. It includes all the earnings reports this morning, including Goldman Sachs and Bank of America. So 12.4% of the S&P 500 market cap has reported results already. That's 36 index members. It's still pretty early, but as you could see, for the finance sector, which is in the bottom third of this list, 37.5% of the finance sector market cap has reported results already. So a decently representative sample for the finance sector. Overall, for the S&P 500 at this stage, earnings are up 11.8% from the same period last year. Revenues are up 7.7% from the same period last year. 77.8% are beating EPS estimates, and 75% are beating revenue estimates. If we go to the next slide, I'll put this in a historical context. As you could see in here, the left side chart is comparing the growth rate, earnings, and revenue. The growth rate for these 36 companies in Q4 17 with what we had seen from the same group of 36 companies in other recent periods. The green bars represent earnings, the orange represents revenues, and we're comparing the results, the growth rates to the preceding quarter, meaning the 2017 Q3, and then we are comparing, taking a 4-quarter average and a 12-quarter average. As you can see here, the earnings growth pace is a bit on the lighter side relative to the to Q3 as well as the 4-quarter average, but pretty strong from a historical perspective. Revenue growth rate, the 7.7% that we have seen already, represents an improvement over what we saw in Q3, the 4-quarter average, as well as the 12-quarter average. The right-hand side chart is the proportion of companies beating estimates. And this goes on to the point that Terry raised about what would market expectations be given how high stocks have been. and given how good the earnings picture has been throughout 2017 as a whole. So you could see that earnings beats are roughly in line with historical periods. But revenue beats, 75% for Q4 compares to 72.2% in Q3. The 4-quarter average, again, we are talking only about the 36 companies that have reported results already, is 63.9% or about 64%, and the historical average is about 55%. So it's a small sample, it's weighted towards finance, but even at this admittedly early stage, you could see that there is momentum on the revenue side. There's momentum on the revenue side, both for growth as well as for the proportion of positive surprises. I want to make one brief comment about the Q4 earnings season and these results before I move on. And the comment pertains to estimate revisions. Regular clients know that we are big on the power of estimate revisions. And one notable trend that we witnessed in the run-up to the start of the Q4 earnings season was how estimates for Q4 did not fall the way they have been falling over the last 4 or 5 years. In fact, estimates for Q4 moved up a tad bit relative to when the quarter got underway on October 1st. So this was a very notable change relative to the trend we had been seeing, and a very positive development. And the reason I'm raising this estimate revisions point is that it goes on to show the value of these beats when estimates go down significantly, largely as a result of management guidance. Then it robs the value of this beats chart that I'm showing here on the right side. The takeaway from that point I'm making is that estimates had not fallen, and even knowing that, we are seeing that companies are beating top lines at a pace that's better than what we have been seeing over the last few years. So a very positive development. Let's go to the next slide. And as I mentioned earlier, only 36 companies have reported results. The bulk of the earnings season is still ahead of us. We have a super busy reporting cycle over the next 2 to 3 weeks. By my calculation, about 300 S&P 500 companies are crammed into the next 3 weeks. So more reports are still to come relative to what have come. And in this table, we are giving you a blended picture for Q4 for earnings, for revenues, and for margins, and comparing that blended picture with what was actually achieved in the preceding quarter, meaning the third quarter of 2017. The third from the bottom row, which is shown as the S&P 500, is the aggregate growth pace and the aggregate values for the index as a whole. As you could see here, 9.9% earnings growth for the S&P 500. Mind you, we are not talking about EPS. We are talking about net income, and net income we see as a better measure of growth than just pure EPS, because it accounts for and adjusts for the trend of heavy share buybacks that management teams have been involved in over the last few years. So total earnings for the S&P 500 as of today for the fourth quarter of 2017 are expected to be up 9.9%. Total revenues for the index are expected to be up 7%, so a modest, about 30 basis points uptick in margins. Typically, the actual results come in 2 to 3 percentage points higher, just going by history relative to what is expected at this stage, which means that when all is said and done for the Q4 earnings season in about 4 weeks, we should see this earnings growth rate to be in the 12 to 13% range as a whole. And you could see here the constituent sectors. I have listed them based on the Zacks sector classifications, which is 16 sectors. And you could see energy is a big contributor here, 177.1% earnings growth for the energy sector. Technology is another big contributor, 14.1% earnings growth. And then the construction, double-digit, industrial products, double-digit, basic materials, double-digit, autos, double-digit, with the conglomerates and consumer discretionary as the only ones that have lower earnings compared to the same period last year. So very strong growth. Not all of it is from energy, even though energy is a big contributor. At the very last row, you have the aggregate figures for the index on an ex-energy basis. So earnings for the S&P 500 in Q4 would be up 7.3% on 5.6% higher revenues, even if we excluded the energy sector from this picture. Let's go to the next slide. And this gives you a graphical representation of where we have come from and where we are headed. So that I mentioned the 9.9% earnings growth for the S&P 500 in Q4. I also pointed out that the actual growth pace typically is 2 to 3 percentage points higher than what is expected at this stage of the reporting cycle, meaning the final tally could very well be in the 12 to 13% range. And knowing that, you have a better sense now of looking at Q4 relative to where we have come from. So it is very likely that the final quarter of the year in terms of earnings growth will be the second in terms of growth rate to the quarter that got the year got underway, the 13.5% for the first quarter of 2017. If you look ahead, we have a very strong double-digit earnings growth outlook, and this is basically reflecting the bottom-up EPS estimates from the covering analysts for each of the 500 of the index members aggregated to the index level. So in the current quarter, the 2018 Q1 total earnings for the S&P 500 are expected to be 12.5%. And as you could see, the growth pace then continues through the rest of the year as well. Let's go to the next slide. And it's not just the year-over-year growth rate, which at times could benefit from easy comparisons. What I'm trying to point out in this slide is the absolute dollar level of earnings for the S&P 500 companies. So what we are showing here, the orange bar in the middle, which has 314.6 on top of it, based on current estimates, the 9.9% growth rate that I mentioned in the earlier slides. This means $314.6 billion for the S&P 500 companies in Q4. This will be a new all-time quarterly record for the index. And this all-time quarterly record, it exceeds the same all-time quarterly record that was set in the preceding quarter, which itself eclipsed the record that was set in the quarter prior to that. So what I want you to take away from this is that the overall level of corporate earnings is extremely high. In fact, it's in record territory. And when you look ahead to the coming quarters, the expectation for the first quarter of 2018, the current period, is for $312.3 billion. And then it keeps going up, with the last quarter of the year expected to bring in a little over $350 billion. So a very strong earnings outlook. I do want to point out make a brief comment. This covers these numbers as well as the numbers we've mentioned earlier. The earnings estimates and actuals that I'm putting out here are not GAAP earnings. These are what we call as net income BNRI, meaning that it excludes non-recurring items. We have relatively greater incidence of one-time items in the Q4 earnings season than has been the norm in recent periods. The tax legislation that is so beneficial to corporate earnings and the market and the growth outlook overall has this unintended consequence of forcing companies that have deferred tax assets, that have foreign earnings, to take charges. And we are seeing plenty of those from the financials that have come out and many others that have pre-announced and guided. So there is this one bit of a cloudy comment about the Q4 earnings season, that even though the underlying trends in terms of operating earnings is very strong, from an accounting earnings perspective, from a GAAP earnings perspective, we have a lot more and more widespread one-time charge announcements this earnings season than it's been the norm in other recent periods. By my calculation, including this morning's reports, the gap between our adjusted earnings and GAAP earnings is currently tracking about $26 billion. If we move to the next slide. So this is key here, and I want to tie this in to one of the comments that John made in his presentation about the risks, where he pointed out that a lot of the positives about the tax cut in terms of corporate earnings, in terms of economic growth, is already priced in. And this is an inexact science. We can all have our own opinions about it, but it's not carved in stone for any one of us to really know with certainty if a particular fact has completely been priced in, or it's slowly diffusing through the market. I mentioned earlier that the estimate revisions trend for Q4 was unusually favorable relative to what we have been seeing over the last 4 or 5 years. And what this slide is showing is totally something that we have not seen throughout this earnings cycle. And by earnings cycle, I mean going back to 2011, 2010, a couple of years after we came out of the recession, estimates have consistently been coming down. And what am I showing you here? What I'm showing here is that for the first quarter of 2018, estimates are steadily going up. So at November 30th, the consensus expectation was that earnings for the S&P 500 would be up 9%. And as you could see from the data points, it was the same by mid-December. But you could see that at the beginning of the year, on January 3rd, this growth expectation had gone up to 9.8%. By January 10th, it had gone up to 10.9%. And this morning, it was 12.5%. The two things to keep in mind, one is the development that's happening with oil prices. That's helping, but that's not all. It's the pretty much everything out of the energy sector can be chalked up to the impact of tax cuts. And I strongly believe that 12.5% is not the final growth rate that's expected for the quarter. Let's look at the next slide. And this slide basically takes the same approach that we saw in the preceding slide, but here, instead of looking at one quarter, we are looking at the entire year. And you could see that on November 30, 2017, the expectation for full year 2018 earnings for the S&P 500 was for growth of 11.6%. And you could see that it steadily started going up, with today being 14.9%. And again, there is a energy component to it. We all know that oil prices have gone up, and the momentum there has been positive, and that's driving energy sector earnings. But that's not all what's happening here. When I tell you the numbers this morning, of the 16 Zacks sectors, estimates have gone up for 14 sectors. So it's not just energy. This slide shows you where this 14.9% earnings growth is coming from. You could see that only 10.5% of the total growth is coming from energy sector. 29.7% is coming from finance. 24.1% is coming from technology. And the finance thing is premised on a stronger economy driving demand for loans being more profitable for the sector because interest rates going up. One could have both sides on that argument, but the consensus of the analysts covering the financials are showing this. If we go to the next slide, and this gives you the big picture of where we have come from and where we are headed at this point in the earnings cycle. 2017 is the orange or the red. I'm not particularly clear on the colors here, but 7.6% earnings growth for the 2017 year. And as we pointed out earlier, 14.9% and rising is the growth expectation for 2018, and then 9.7% for 2019, you would see those flattish kind of growth pace we saw in 2016 and 15. A big part of that was what happened to the energy sector, but it was a broad-based slowdown in earnings growth. We came back into our own in 2017, and the pace is accelerating in 2018. So the overall takeaway, and this was the last slide, the overall takeaway that I want you guys to have is that of the multiple variables that are at play in pushing stocks, one of the most important ones is earnings, and the outlook for earnings has not been this good in a very long time. And the rate and direction of change with respect to estimates is positive and favorable, and that should give market bulls, those of you who still see plenty of upside, reassurance and confidence in your investment decisions. That's all clearly for me.
Okay, Sheraz, thanks. And once again, unfortunately, that's all we have time for today. So we want to thank our panelists, John Blank and Sheraz Mian. We hope you found their comments informative. If you have any questions regarding our services, feel free to email them to zrs@zacks.com. But if you would like to view John's or Sheraz's PowerPoint presentations featured in today's call, or you'd like their most updated strategy or earnings trends reports, again, zrs@zacks.com is where you should email, or simply contact your ZRS representative directly. In the meantime, thank you for joining us. Feedback, remember, always welcome, and we look forward to the next time we're all together on the call.